Hi everybody, welcome back to the channel. Hope everybody's staying safe out there. Stay indoors, please. Unless it's an emergency, there's really no need to go out in this snow if you've been hit with a snowstorm. We were hit, I think, with well over 6 inches at this point near St. Louis, Missouri and southern Illinois. But I hope everybody's doing well out there. Thank you so much for tuning back in to another video. And we are talking today about the VIG ETF, the Vanguard Dividend Appreciation ETF. And you'll see that I have my Fidelity account pulled up here. I also have this trade locked in as a hypothetical. And I want to explain how we can use the wheel strategy along with dividend income against this ETF for basically retirement, right? And you can combine a number of these ETFs. Like I made one on SCHD, or the Schwab US Dividend Equity ETF. This is on VIG, or the Vanguard Dividend Appreciation ETF. So you can kind of divide it up however you want, but when it comes down to it, the whole goal is to, one, utilize the wheel strategy, and two, try to earn dividends on top of the wheel strategy with these ETFs. And let's call it, say a $500,000 portfolio. Now, if you have a $500,000 portfolio, I would say you're in a better position than a lot of people out there in terms of, one, your retirement nest egg, and two, the cash flow that you can earn from that retirement portfolio. So even if you're not at that place, the goal, I think, long term for a lot of people is to get to a point where they may have $500,000, $1 million nest egg, if not more, especially when we consider inflation, when we consider 20 years from now, if I'm looking at retirement, what is that going to look like? In terms of, is 500,000 the new 2 million? Is 2 million the new, whatever it is? So you get to these higher numbers and you start to think, well, how can we earn this type of cash flow? Now, some of you may be looking at this and thinking, well, 500,000 is just a ridiculous number. But keep in mind, like with inflation, this is going to become more common to see portfolios in the $500,000, $1 million range, million plus. A lot of people already have these portfolios, and you might be in that situation watching this, or that might be one of your goals long term. So that's kind of what we're getting at in this video. Hope you all enjoy it. Let's get into it. So the first thing you'll see here is I have a locked-in trade for a cash secured put. January 17th, 2025 is the expiration. Hard to believe we're in 2025 already. January 5th is the day. Okay, so January 5th versus January 17th. That's 12 days to expiration. The strike price is 193. The quantity is 25. So this is basically right under $500,000. Okay, so right under 500,000. Now you can divide this up between multiple ETFs. In fact, if you wanted to do like SCHD along with VIG, along with VYM, along with all these different dividend ETFs for this strategy, you could absolutely do that. In fact, if you feel more comfortable, if it helps you sleep better at night, you could put 50,000 in this one, 75,000 in another one, and just kind of divide it up into multiple different dividend ETFs that are already diversified. And then you get additional diversification on top of that. So even though we're factoring, 25 contracts, which is the equivalent of 2,500 shares at a price of 193, remember, this is just a hypothetical example of what's possible. Okay, so 25 times 193 is going to be the equivalent of 2,500 shares, because each options contract is 100 shares. And if we look at 25 times 193, we're looking at a capital of $482,500. If you look at our net loss, it's basically subtracting the premium, and then you get your max loss of $480,000 if the ETF basically goes bankrupt, which we know is not going to happen because the ETF is well diversified and has multiple dividend stocks in it. We'll get into that here in a little bit. But 193 times 25 contracts is a put option, sell to open, January 17th, 2025. And if you're new to put options, I encourage you to do research, check out, articles on the wheel strategy. But basically what we're doing is we're doing puts and calls in rotation. So we're selling cash secured puts, and then we're selling covered calls. The thing to keep in mind when selling cash secured puts is that your capital is on the line at 193 for 2,500 shares up until the expiration day. So we are locking in this trade, agreeing to buy 2,500 shares of VIG, or the Vanguard Dividend Appreciation ETF, VIG, at 193 up until the expiration date of January 17th, 2025. And if the ETF is under 193 upon that day, then we will get long our shares. But keep in mind, this premium right here of $1,733 once we lock in this trade is ours to keep. And this is in less than a month. This is only 12 days that we're earning this. You'll see they have different expirations going out to February, and there will be more expirations that come out as it gets closer to like March and stuff, I'm sure. But right now we have the January and the February expiration we can choose from. So $1,733. You guys, the February expiration, you're going to get more premium just because it's longer out to expiration, more time for it to go in the money. But we're trying to basically do this in 12 days, turn it around, and then worst case, it goes below 193. Now, something to keep in mind with this ETF is that if we look at the actual support levels and where this is traded, 194 is actually a pretty solid level of support, I would say. So it's kind of hitting a double bottom almost right here, 194. Maybe it'll rebound from 194. The next support level is at 190 or 189. And that goes all the way back down to September. So, 190 right here. We had a brief dip down to 189, a little gap on the chart that filled. And then we go all the way down to 180. That goes back to August. And so if we see a retracement in the ETF, yeah, it's possible. That's a risk. That's why it might, be a good idea also to do this against multiple ETFs, as, I've talked about on the channel. But in this hypothetical example, we have a $500,000 trade almost, and our support level is 194. So we're basically aiming at 193, which gives us a little bit of leverage, assuming this is a double bottom, right? And so worst case, it goes below 193, we get long, and then we try to turn around and sell a covered call. So since the share price right now, the ETF is 196, okay, 196 for this ETF. It's, we have $3 of margin. So up until expiration day, this has to go below 193 in order for us to then get long the shares, and then from there we turn around and we sell a covered call if that were to happen. Now, let's say at that point, let's just take 198, it's out of the money. So 196 versus 198, we're basically selling a $2 out of the money January 17th still. So now you can kind of see on the call side, we're collecting over $2,000. At $200 a share, you're not getting nearly as much. But $600, 199, you're still getting something, right? You're still getting over $1,000 for that trade. And so now you're actually long the shares, right? And this is something else to keep in mind, because when we're looking at the expirations, okay, so when we look at, for example, if we take, let's just go back and look up the dividend history for the VIG. And I'll show you when the ex-dividend days are, because what we want to try to do with this wheel strategy is time out the expirations. So you'll see the payment day. The most important thing is going to be the ex-dividend day, is when you have to basically own the shares to get paid the dividend. 1223 to 1226, you'll see a pattern here, right? So you'll see that basically 7-3-12, 7-3-12. So there's a September there. But you'll see a consistent pattern. So if we can look at the last dividend of 12/26, we can probably assume the next dividend is going to be paid sometime in March. Now, currently, there's no March expiration to choose from. So that does present a problem. But what we could also do, if we're already long our shares, okay, we could just go out to the May expiration. Now, you'll see here that if we're willing to cap our upside at, let's say, $200 even, or even higher than that, we're getting a lot of premium here. We're getting $11,000. Now, that is going to be about, 5 months out. So divide that by 5 and you have, maybe over $2,000 a month. That's the equivalent of that near dated expiration we look at. But since we're going past the, looks like there's an advertisement here. I'm sure I have advertisements on my videos too. Thank you all for, you guys watching keeps the channel running. I mean, I'll be honest, I'm fully monetizing this channel now, so thank you all for tuning into this video. And for those of you guys who have made it this far. So 12/26/2024, the next one we can probably expect in March. This expiration goes out to May. So the idea is the buyer of the call option, we're the seller of the call option. The buyer of the call option may not exercise. A lot of times they don't go exercise. It's a random exercise notice up until the expiration day. And so you might not actually get your shares called away up until the expiration day. And so since you actually own the shares still, you're still going to collect the dividend while you're additionally waiting for this option to expire. Maybe it expires worthless, maybe it doesn't. But the downside is your upside is capped at $200, right? So that is the downside. You can go to 205 and get less. Now you're getting $2.35, just over $5,000 or $1,000 a month right there. But you're earning premium, right? And so what happens is at the expiration day, if it's not below 200 or below 205, just the opposite of the put option. It has to be below these prices instead of above. Then the buyer of the call option basically will call away your shares. Now, that's auto exercise. That's basically the last day of expiration. But up until then, we can still, one, collect the premium, and then additionally, we can collect the dividend, assuming the buyer of the call option does not exercise. Now, that is a risk to consider. They can exercise the option basically any time, but it's a random process. And so people who exercise the option, even though a lot of them are just sold back onto the market, that is a risk to consider. But since we're going past the expiration day, the point is, the next dividend is expected to be paid in March, as can be seen from the last few patterns. The next ex-dividend day is expected to be in late March as well. So really, all we have to do is make it till March, and assuming we still own our shares, even if this is above, let's say 205, 200, or 210, depending on what strike we choose, for example, we're still going to collect the dividend in addition to keeping this premium. And then maybe we can turn around at that point and, sell a put option again. So that's the whole idea with this wheel strategy. The whole idea is get long through puts, then take an expiration past the next expected dividend, try to collect that dividend, and then, eventually maybe your shares get called away upon the expiration day, turn around and, try to do it again. So that's the whole idea here. Now, looking at the long-term chart, like I said, you can kind of look at the technicals of this. Nice consistent uptrend. So is it a good time to sell puts on it? I would say so. Maybe that 194 level is a good level to sell some cash secured puts. If we look at, once again, this 194 level on this chart, same thing. And once again, this is our total capital that we're putting up for this hypothetical trade, $482,000 or just under a $500,000 portfolio. And, every 3 months, you'll see the dividends being paid out here, 9/27, 12/23, as we just went over, 3/22, March. If you look at the total return of this ETF, though, you'll see over the last 5 years, we have a consistent uptrend. One thing to watch out, or one thing to really consider with these dividends as well, you have the 16% return over the last year. The yield is pretty low. So people look at this yield and think, well, that yield sucks. I mean, on a $500,000 portfolio, even if you do collect that dividend while doing the wheel strategy against this ETF, you're only looking at $8,950 in initial dividend income per year. That's only $745 a month. So you might be doing $1,000 a month in call option or wheel strategy income, just under $2,000 a month, right? If you're doing another $1,000, you're taking a little bit more risk. Now you're doing $2,500 a month. Is that really enough to retire on? Probably not, unless your expenses are really low. So one thing to keep in mind with this ETF, though, is that these dividends have been increasing consistently, as you can see. So, thinking about this from 5 years from now, if we can sustain this for a period of time, these dividends are likely to be a lot higher. If you look at these previous dividends, we're going from 30, 40, 50, 60 cents, 70 cents, 80 cents, 90 cents. The next we're going to see $1. Okay, we haven't really had any dividends that have been over $1 yet, but I think that's next on the line. We're seeing 80-cent dividends, 70-cent, 90 cents. We're starting to work our way up consistent, or I guess it's like this anyway. So we're seeing a consistent uptrend, and these dividends are just consistently going up over time. So one, you do have a low dividend yield. Two, that dividend yield is, not the yield, but the dividend itself is going up over time. You're seeing consistent dividend growth, hence the name Dividend Appreciation ETF. So we're appreciating in share price. That's number 3, in addition to the dividend going up as well. So we have dividend growth, even though we have a low yield, and we have share price growth. Okay, so that's good. And assuming you're not totally capping your upside on the call side, you're probably still making some money depending on how you're positioning your trades with the wheel strategy. So that's the whole idea. We just want to earn consistent cash flow through a combination of the wheel strategy along with dividend payments. So consistently selling puts and call options, going out past the next expected ex-dividend day for the expiration we choose, and then choosing a strike price that's reasonable that will also allow us maybe to earn some upside, say on the call side, and maybe give us a little bit of room to work with on the downside of, if you're selling a put option, right? So that's the whole idea. Now, if we go over to the actual page on Vanguard, we can see that the expense ratio on this one is 0.06%. Vanguard Dividend Appreciation ETF. The category is large blend, domestic. Whoops. I don't know what just happened. Let's see here. There it is. Okay. Anyway, I'm trying to move my camera, but that's all right. 0.06 is the expense ratio. Now, that's very low. That's less than 0.1%. That is a great expense ratio. A lot of these ETFs you'll see, 0.5, 0.75 expense ratio. A lot of mutual funds, you'll still see over 1% expense ratios, which in my opinion, unless you're getting a ridiculous return on that mutual fund and it has a proven track record, is kind of ridiculous. I mean, this is 2025. The markets have changed. Vanguard does a very good job at providing high quality funds at a low cost, and that's what I like about them. I even have a friend who's been investing in Vanguard ETFs since he was like 4 years old. His grandpa started a fund. And I'm probably going to do that for my kids too here pretty soon. I think it's a really good idea when you think about, compounding and all that. But that's another story. If we look at this right here, you can see the product summary seeks to track the performance of the S&P 500 U.S. Dividend Growers Index. It's a passively managed full application approach, and it remains fully invested. Large cap equity emphasizing stocks with a record of growing their dividends year after year, and it has low expenses, which minimizes net tracking errors. Now, the minimum investment for this is only $1, 0.06 expense ratio. That would be if you're buying like fractional shares, by the way, since the share price is obviously higher. Market price change, you can see, just from the past day, net asset value change is going to be a little bit different in terms of the actual market price change. We can get into that. But if you look at the performance and everything, you'll see the 5-year, 10-year return, not including dividends or anything. If we look at the actual positions, and if we have, let's say, here's the portfolio composition, 338 stocks. So you are well diversified in this ETF. We have an earnings growth rate of 12%, a PE ratio of 26.7%, price to book ratio against the entire portfolio of 4.9. Looking at the actual sectors, you can see consumer staples 11.5%, financials is probably the heaviest, along with information technology 23% in terms of those sectors. Utilities and materials are very low. Those are probably going to be your more safe benchmark type assets. When we go into a recession, utility stocks typically hold up okay. Technology is going to be a little bit riskier, but it just comes with a well-diversified portfolio. Remember, we have the NASDAQ stocks, everything. We're having over 300 stocks here, and the weights as well. Keep in mind, some of these stocks like Apple have 4.75% weighting. Okay, so some of these do have heavier weights. Home Depot 2.19%, Visa, Microsoft, but you have the big dog companies. You can go through here and just look at how small the weights get though as you go on, right? So 0.24, 0.23, but collectively it does add up. So 50 stocks might add up to, let's say, 5 to 10% of the portfolio right there, or 10% plus, or whatever it is, depending on the specific weighting. But you can also go all the way down here to the last of the last, and this is where it's like pretty much nothing, right? But in lieu of the size of the portfolio, we still have a $2.9 million position in terms of the total ETF. So I find that interesting. And now we get to the fun part, as we already discussed, the dividends, of course, and distribution schedules quarterly, and it goes over the fund management here. So it tracks the investment performance of the U.S. Dividend Growers Index, which consists of common stocks of companies that have a record of increasing dividends over time. It'll hold all the stocks in the index in approximately the same proportions as their weightings in the index. The experience and stability of Vanguard's equity index group have permitted continuous refinement of techniques for reducing tracking errors. The group uses proprietary software to implement trading decisions that accommodate cash flow and maintain close correlation with index characteristics. Vanguard's refined indexing process, combined with low management fees and efficient trading, has provided tight tracking net of expenses. So that's pretty much the overview of this ETF, and I hope you guys enjoyed this video. Just to recap, so I've made another video on SDHD similar to this one, going over how we can use the wheel strategy along with dividends to earn this income from our portfolios, and how we can do it on a larger scale, say a $500,000 portfolio. And like I said, long term, especially if you're in your building retirement stage, let's say you're in your 20s or 30s, you're younger, even 40s, you still have some time to build a retirement nest egg. Building a $500,000 portfolio, $1 million portfolio that spits out cash flow using these various techniques is not going to be totally unrealistic, especially when we consider inflation and what we've seen in terms of, what used to be considered a very large portfolio and would be like a dream come true for many. And it's still a decent amount of money, but when you consider, like I said, inflation and the cost of living and everything, I think this is going to become more common, and it's going to be easier to achieve, to obtain these types of portfolio amounts. So with that being said, guys, once again, thank you so much for tuning in. God bless you all. Stay safe out there. If you're in the snowstorm, try not to go out unless it's an emergency. I know I said that in the beginning of the video, but this is pretty dangerous stuff. There's a lot of ice out there, a lot of snow. So definitely stay safe out there, guys. Thank you so much for tuning in once again, and we will see you in the next one. Take care.